Hello number curious friends, welcome to the channel where we talk accounting and finance. Today we look at a small balance sheet line item which hides a lot of information, other current assets. By the end you will know what usually sits inside, how it gets there, the basic journal entries and what to watch in real reports. But first a quick refresher, an idea of the current asset. A current asset is something you expect to turn into cash, sell or use within 1 year or within your operating cycle if that is longer. Cash, trade receivables and inventory are the big three. The other current assets line collects the smaller current items that do not fit those big buckets. What does commonly sit in other current assets? Contents vary by company, but you will meet the following items again and again. Prepaid expenses. Amounts paid now for future benefits within a year, for example, insurance, rent, software subscriptions. Recoverable taxes, that would be VAT receivable, sales tax receivable, income tax prepayments or overpayments and other. Advances to suppliers, which mean deposits or prepayments for goods or services not yet received. Short-term deposits that are not cash equivalents. For example, a 6 months deposit if your policy treats only up to 3 months as a cash equivalent. Contract assets. Here you have earned the right to consideration but are waiting on a condition. This is common in service and long-term contracts. Current portion of long-term receivables. These are installments due within 12 months, for example on loans or leases you granted. And many other items, for example insurance claims receivables, employee advances, deposits with utilities, and similar balances expected to clear within a year. And before we move forward, if you find our lessons useful, please take a moment to hit a like button, subscribe to our channel and leave a comment. Your support is very important to us, and thank you for being with us. Let's have a look at those items with our Apple shop as an example. Let's start with prepaid insurance. We pay for 12 months of insurance upfront for the delivery truck. The cost is $1,200 for the year. What happens here? Do you remember how we phased revenue received in advance? Deferred revenue, deferred income? Same applies to expenses. We need to match cost with the actual usage of the service. And here, unlike deferred income, we have an asset, as now someone else owes us a service for the money we paid in advance. So it's an asset for us, a claim to our supplier to provide services. When we make a payment, the journal entry would be debit prepaid insurance in other current assets $1,200, credit cash $1,200. Then each month we recognize expense to match the service with the period where we receive this service. That would be 1/12 of the full amount or 100 per month. Debit insurance expense 100 in the P&L, credit prepaid insurance 100 to decrease the balance of the asset as we utilize it. And we continue so for 12 months until we run out of the full prepayment of 1,200. Now VAT receivable as an example. We buy apples for $2,000 plus 20% VAT and plan to recover this VAT. The journal entry would be debit inventory 2,000, debit VAT receivable other current assets 400 and credit accounts payable 2,400. When we offset VAT against the VAT payable on sales we make, we reduce VAT receivable for that amount. And yes, normally the net amount of VAT is paid to tax authorities. Advances to supplier for our Apple shop would mean, for example, a 500 deposit for jars. The jars will be shipped for us next month. Debit advances to suppliers, other current assets 500, credit cash 500. When the jars arrive, we move the deposit into inventory, as now we have jars instead of the deposit, another asset, a reclassification. Debit inventory 500, credit advances to suppliers 500. Now a short-term deposit, not a cash equivalent. We park $5,000 in a 6 months term deposit. It is liquid, but longer than our cash equivalent policy. The journal entries would be debit short-term deposit, other current assets 5,000, credit cash 5,000. When the deposit expires, we reverse the entry and move it back to cash. Now let's have a look at a contract asset for a simple service job. Let's imagine we perform apple orchard maintenance services for our farmer, and this month they are worth $3,000. But the contract can be billed only after the farmer accepts the service next month. Control passes over time based on milestones. We deserve the revenue and should recognize it, but instead of trade receivables, as we still have not sent a bill and the customer has not accepted the service, we recognize contract assets. Debit contract asset, other current assets 3000, credit service revenue 3000. This one in the P&L. When we invoice after acceptance, we reclassify the contract asset to trade receivables. Debit accounts receivable 3000, credit contract asset 3000. Why do companies use the other bucket and what to watch? Grouping the smaller items keeps the balance sheet tidy, but you should still understand the mix. Here is what to watch out. Prepayments are rising quickly. Did the company pay 12 months in advance for many items, or is it capitalizing things that should be expensed, artificially decreasing the cost base? Recoverable taxes. Large balances can be normal with VAT, but very old amounts may be hard to recover. Advances to suppliers. These are healthy for securing materials, but constant large advances may mean delays or supplier risk. Contract assets. These grow when performance is ahead of billing, but significantly growing balances may, for example, mean that there are problems with customers accepting our services. Where do other current assets appear on the balance sheet and how do they link to the cash flow? On the balance sheet you will see other current assets as a single line, sometimes with a breakdown in the notes. For both IFRS and US GAAP it is the same idea, with small label differences. Both frameworks use the same logic. Current means within 12 months. You may see different labels like other receivables, prepayments, contract assets under IFRS, or prepaid expenses and other current assets under US GAAP. Focus on substance, timing of use and recoverability. For example, Unilever shows them on the balance sheet in trade and other current receivables. When we follow note 13, we see on page 167 0.5 billion of prepayments and accrued income and 1.3 billion of other receivables. And the note describes that these include supply and customer deposits, advances to employees, and reclaimable sales tax. NVIDIA in its turn shows 3.8 billion of prepaid expenses and other current assets, but they don't provide further details. PepsiCo also shows prepaid expenses and other current assets, 0.9 billion. Here, on page 75, we can see that they include upfront payments to customers for incentive agreements, 237 million. On page 76, we also see that there is another component, deferred or prepaid advertising costs, 58 million. And where do other current assets appear in the cash flow? In the cash flow statement under the indirect method, the change in other current assets adjusts operating cash flow as part of working capital. If other current assets increase, cash is used. If they decrease, cash is released. The driver could be prepayments made early, delayed or accelerated VAT filings, deposits made or refunded, or contract assets growing or build. And now a few words on simple controls and good habits for other current assets. Treat other current assets folder like a kitchen drawer. Clean it regularly. Do aging reviews for VAT receivables, supply advances and contract assets. Set up expense schedules for prepayments with monthly amortization. Keep supporting documents for deposits and claims. Netting and offsetting rules. Know which tax receivables can be offset and when. And do cut-off testing at month ends so costs do not pile up in prepayments by mistake. And here are the usual pitfalls and how to avoid them. The first one, booking loan deposits into cash instead of other current assets. Check original maturity and policy. The next one, forgetting to amortize prepayments monthly. Build a simple amortization table. Leaving old VAT claims unreviewed. Investigate and write off if not recoverable. Classifying advances to suppliers as inventory too early. Only move them when goods or services are received. Mixing contract assets with receivables. Receivable means the only barrier to payment is time. Invoice is typically out. Contract asset means another condition must still be met. Let's summarize the lesson. Other current assets are part of working capital. Similar to inventory and trade receivables, when they rise, cash can get trapped. When they fall, cash is released. Knowing what is inside helps you read the story behind the number. timing of prepayments, tax positions, advances, contract assets, and small financial assets. That is the other current assets in plain language. Thank you for watching. If you enjoyed this lesson, hit like, subscribe and ring the bell so that you don't miss the next lesson. See you soon and keep those debits equal to your credits.